And with that, I would like to introduce our presenter today. We have Emily Cadik is the Executive Director of the Affordable Housing Tax Credit Coalition, where she leads advocacy to support affordable rental housing financed using the low-income housing tax credit. Prior to joining the AHTCC, she was a Senior Director of Public Policy at Enterprise Community Partners, where she led policy and advocacy related to the housing tax credit and other affordable housing and community development issues. And she was also a Presidential Management Fellow at the U.S. Department of Housing and Urban Development. With that, Emily, I pass it over to you.
Great, thank you. Good afternoon, everyone, and thank you for joining, and thank you to Gail and the Housing Alliance of Pennsylvania for inviting me to talk about this very important and very timely topic of reforming the Community Reinvestment Act. Once again, I'm Emily Cadik. I'm the Executive Director of the Affordable Housing Tax Credit Coalition, and we represent about 200 organizations and businesses, including the Housing Alliance, that advocate on behalf of the housing credit. So we represent developers, syndicators, investors, and really the full spectrum of the affordable housing community. And really all of these groups stand to be significantly impacted by some of the changes that the administration is currently proposing related to CRA. So in today's webinar, we're going to talk about what those changes are. Certainly at a high level, this is an extremely dense proposal from the administration, so we want to stick to what the most important changes for affordable housing are. And then we'll discuss what the potential impacts might be, what stakeholders can do to weigh in, and then after that I'll turn it back over to Gail for a bit of a deeper dive on how to provide public comment. So let's start with the very basics on what is the Community Reinvestment Act, or CRA. So the short answer is that CRA was the federal government's response to redlining, which is the practice of discriminatory lending, which was ultimately outlawed. So what you see here is what's called a Redlining Map of Philadelphia. You can find these for a lot of cities. They're pretty fascinating. And you can see where banks had, back in the day, designated certain areas that they just weren't going to invest in or considered very high risk. And that contributed to a lot of the segregation and inequality that we, of course, still see today. So CRA was designed to make banks more proactively take steps to make up for the injustices that have occurred by, broadly speaking, investing in the communities in which they do business. So there are now a number of ways that banks can meet their CRA obligations, which we'll discuss more in a minute. And there are 3 agencies that determine whether banks are meeting their CRA obligations. So that's the Office of the Comptroller of the Currency, or the OCC, the Federal Deposit Insurance Corporation, or the FDIC, and the Federal Reserve, or the Fed. So we'll talk more about those 3 agencies in a minute and what they're doing. But first I want to underscore why CRA is such a focus right now. And the reason is that the administration is seeking to undertake a major reform effort that we haven't seen in over 2 decades. The Community Reinvestment Act was first enacted in 1977, and though there have been some updates since then, there hasn't been a major overhaul in over 20 years. Meanwhile, obviously, there's been a lot of changes in the banking industry. For example, online banking wasn't really around last time CRA was overhauled. So there's some agreement that reform is needed, and that's why it's currently on the table. But some of these changes to CRA can also have very significant impacts on a lot of the types of activities banks have been engaging in order to meet their obligations. And we're especially concerned about some of the potential impacts for affordable housing. So CRA has been a major driver, really the major driver, in investment in affordable housing, and especially the low-income housing tax credit, because the credit's a good way to meet the investment test, which is currently a part of CRA examinations. The vast majority of investors in the program are CRA-motivated banks, which currently make up close to 3/4, 73% of all housing credit investments. And that was actually higher before Fannie and Freddie got back in the market a couple years ago, where CRA-motivated banks were making up as much as 85% of the market share. So, there obviously are non-CRA investors or economic investors, which are often insurance companies and the like, But the CRA-motivated bank investors have been generally willing to pay higher prices for these credits because of the CRA benefits they receive, which means that ultimately they're able to put more housing credit equity into the deals that they invest in. Not just the pricing and amount of investment, but CRA also impacts where affordable housing gets built, because banks are required to invest in the communities in which they do business, which is known as their CRA footprint. So in places where a lot of banks do business, there's heavy competition to make investments that satisfy the CRA obligations, which creates what are known as CRA hotspots, where meanwhile in areas where fewer banks do business, it can be much less competitive, and so we call that CRA hot versus not, or CRA deserts. There's a study from Cohn-Resnick that's cited here that showed that the pricing differential between these so-called CRA hotspots and the CRA deserts can be as much as 15 cents. So that goes to show just how much of a driver CRA is in the price that investors are willing to pay per credit. And that's really the high-level overview of why we're so interested in the changes to CRA that the administration is proposing. So now we can get into what is happening right now. So once again, there's the three agencies that oversee CRA. There's the OCC, the FDIC, and the Fed. The OCC covers about 70% of banks, and the FDIC and Fed each oversee about 15%. So not only does the OCC oversee most banks, but really even a higher share of the banks that invest in the housing credit. So the actions that they're taking are poised to be especially impactful. Joseph Otting, who you see here, who's the controller of the currency over at the OCC, is the one who's really spearheading the administration's CRA effort. He has a banking background. He came into office extremely motivated to do something on CRA, and essentially told the other regulators that he was moving forward with or without them. And indeed, he started off by moving forward without them. So just before the OCC came out with this proposal about a month ago that we'll talk about in a minute, they had issued an advance notice of proposed rulemaking that they did on their own, and then they ended up getting the FDIC to join them in their comments or in their proposal a couple months ago. The Fed is going in a different direction. She actually said in a speech a couple of weeks ago that they're going in a pretty significant alternate approach, which is really notable because the three agencies would traditionally put out regulations on CRA jointly. So that still may happen at some point, though there is a lot of daylight between the two approaches, which we'll talk about. But it's very notable that the OCC is really driving this effort. So here's an overview of where we are in the process. Just a little over a year ago in 2018, the OCC led the way by putting out its first advance notice of proposed rulemaking, which again it put out without the FDIC. And they got over 1,500 comment letters in response to this notice, including from us, from the coalition, and from many others in the affordable housing industry. So it wasn't until this past December that they were able to put out the next step, which is the notice of proposed rulemaking. And that's the one that, as I mentioned, the FDIC signed on to at the last minute. So this proposal came out in December, but it wasn't officially published in the Federal Register until January 9th. So that's what started the clock on the 60-day comment period. It means comments on this latest rule are due on March 9th. It's also worth noting that several banking trade groups, including the affordable housing lenders, requested an extension so that they could have ideally 120 days to comment on the proposal. So we'll see if anything changes relative to the comment deadline, but as of now, we're operating on a March 9th deadline. The OCC really wants to have a final rule completed and published this summer, which, as I mentioned, given the differences with the Fed, they may end up just doing this as the OCC and FDIC, and that's, of course, if they can get there, but that's the goal. The head of the OCC serves at the pleasure of the president, so there's a lot of motivation to get something in place in the current administration. Now, it's one thing to note that even if a final rule is published this summer, it's not going to change things overnight. It wouldn't go into effect for a couple of years, and even then it would be on the bank's examination cycle, which could be any time in the next 3-year window. So we're really looking at a 2 to 5 year implementation window. And as you all know, there's a presidential election in November. So again, since the heads of these agencies serve with the president, we could potentially have a new OCC controller, or the whole process could be upended and either dramatically changed or overturned if there is a change in administration. So these questions about the staying power of what might be implemented and just the phase in general are something to keep in mind as we dive into some of the concerns we have, though that of course doesn't mean we're taking the proposal any less seriously. So what is actually in the proposal? Whereas the current CRA regime has an investment test, which I mentioned makes it very appealing to make investments like those in the housing credit, the new proposal would do away with that in favor of a much broader formula. So basically what it would do is divide all of a bank's CRA eligible activities by the bank's size, come up with a ratio, which is being called a single ratio, and that would determine whether or not a bank is meeting its CRA obligations. Now, there is a requirement that at least 2% of these activities are community development, but we consider that threshold pretty low. The single ratio is certainly a concerning part of this proposal, but actually more concerning is the very significant expansion of the types of activities that can get a bank CRA credit. So there are now things that are much easier than housing credit investments, like loans, that can get a bank to its CRA target much faster. And then even things like stadiums and bridges could count, so that just further dilutes the incentive to invest in affordable housing. Now, I should note that there is double weighting for certain community development activities, so investments in the housing credit would count for that. But then the concern is that if you could get twice as much credit for the same investment you were doing before, that you would only do half as much investment in affordable housing and still hit the same target. So we don't know yet, we haven't been able to really get any information or data to empirically show what this would do to a bank's investment, and certainly, understandably, many banks aren't at a point yet where they're willing or able to say, here's how this would affect our appetite. But you can imagine the issue if now instead of having one category that the housing credit very easily and effectively satisfies, it's diluted in a much larger pool of other activities, and the housing credit may just be a less attractive investment. Now, on the plus side, there are some changes to modernize the concept of CRA assessment areas. So banks don't just have to invest where they have physical branches, but can get CRA credit for making investments in some other areas, such as underserved communities like Native American areas, distressed areas, opportunity zones. So that's one of the things that we did encourage, that we're glad to see in there. But again, really significant concerns about the weighting and evaluation metrics overall. So to just kind of draw this out a little more, what these changes to the assessment areas could do is help get some CRA-motivated activity in areas that haven't been able to get as much. So where there's places like Salt Lake City that have a lot of banks there, they now have more CRA investing than they know what to do with, and the pricing's really high. But we could even out some of the issue of CRA hotspots versus deserts. But again, we're concerned that's not going to be enough to even out some of the potential very negative consequences, which include, as I mentioned, that it'll be much easier for banks to meet CRA obligations. And even if many of them believe in investing in affordable housing, at some point it may just not make as much economic sense as it does right now. So banks could scale back significantly on their affordable housing investments. And when they do invest, they may be willing to pay a much lower price for the credits, which ultimately means fewer dollars for affordable housing and the people we serve. And of course, the housing credit already saw a pricing hit after tax reform, so a further drop in pricing could really compound that effect and really strain the market. Again, I want to emphasize that we don't expect any of this to take place overnight or abruptly. It's going to take banks a while to figure out the impact. That's why they're requesting an extension on the deadline for the comment period. And we don't expect this to be like it was after the 2016 election, where the prices dropped immediately in anticipation of the lower corporate rate. But if the administration stays in and this rule is finalized and moves forward, we could see a significant effect on pricing as we move forward in this process. So how do we as an industry respond? Once again, when the OCC originally put out its advance notice, they got 1,500 comments, and that was only when we knew where they were heading conceptually, but without many details. So now that we have a bit more information, though again, we still don't know what the full impact will be, but it's really important to outline what our concerns are. And we're going to be reiterating a lot of what we underscored in our response to the advance notice, which the basic premise was, and I'll note that you can find the Tax Credit Coalition's comment letter on our website if any of you are interested. Certainly feel free to use any language or stay in touch with us, as you develop your own responses. But the basic premise is any changes to CRA should allow us to continue to produce at least as much affordable housing as we do today. So we opposed the single ratio approach. We urged the OCC to retain the separate investment test, which they are not, or at least are not proposing to at the moment. We urged that if they're going to expand what qualifies as a CRA eligible activity, that it not diminish the incentive to invest in the housing credit. So again, that's certainly not the case in the proposed rule we just saw. And as I mentioned, we did support the expansion of assessment areas, so we're glad to see that now. And we also encouraged more timely and transparent examinations, but these points really pale in comparison to the more serious concerns we have about what this proposal will do to appetite for the credit overall. So again, the Fed has a very different approach, and we don't really have a lot of detail yet, but what they indicated, and in a pretty notable timing, is they gave a speech on CRA the day before this proposal was published in the Federal Register. So they were certainly signaling at a very important time for the OCC and FDIC that they were not part of this effort. And what they are proposing to do is what they're calling a tailored metrics approach rather than a single ratio, which would have separate retail and community development tests, but would also not have the separate investment test. They did say that they're going to be more focused on empirical analysis, and they're supposed to be releasing some data that has informed their approach sometime in the near future. So we're not actually expecting them to put out anything like the OCC and FDIC did anytime soon, and they do not seem to be responding to any of the pressure from the OCC to get moving. Actually, at her speech at the Urban Institute, the Federal Reserve Board Governor, Lyle Brainerd, said it's much more important to get reform right than to do it quickly. And while she said they do hope that the three of them can eventually get on the same page at some point, if the OCC and FDIC want to publish their own rule this summer without them, they're not going to, it looks like they're not planning to sign on just for the sake of signing on. So we could end up in an environment where 85% of banks are overseen by one set of regulations, 15% by another. Clearly not an outcome anyone wants, but that may be where things are heading. So we are, at this point, waiting for more information from the Fed, but in the middle of all this, we're in this comment period from the OCC and FDIC, so that's really top of mind for us. So we would certainly encourage all of you to weigh in and let the OCC and FDIC know that affordable housing groups are very concerned about this approach. Of course, it's always best to frame comments constructively and not attack the regulators or the motives or even the concept of CRA reform. One thing we heard over and over from Comptroller Otting during the process was even when there were critics of the proposal, he would say, well, everybody can agree we need to do CRA reform, right? So, going back to the original point that the regulations haven't even been updated to reflect things like online banking, certainly, approaching these comments with an acknowledgement that there are some reforms that could be helpful, but we want to make sure that they don't harm affordable housing and our ability to serve low-income families who need affordable housing. So I would encourage you all to weigh in. The comments are due on March 9th as far as we know, and you can pull any language that you want from the coalition or our partners. The action campaign, which we're on the steering committee of, is also going to be putting together an industry comment letter. So, we have some of these national voices that are weighing in on behalf of the, affordable housing and preserving investment throughout this process. But it's one of those situations where more is more, and we would really like as many voices from all different parts of the affordable housing community and all different parts of the country to be weighing in response to this proposed rule. So with that, I'll turn it back over to Gail. I don't know if you want to do questions now or talk about the comment process, but I will turn it back over to you.
I do want to just take a few minutes to open it up for any kind of clarifying questions from folks in the audience. But like Emily said, I mean, this was some really, really great information. We are in a couple of minutes just going to go over to the regulations.gov website to run through what it looks like to actually submit a public comment letter. But for those who have maybe already done this and just have a quick question, now's your time to ask. If you just want to raise your hand or submit a question via chat. All right, then let's go over to the website. So I'm messing with technology for the first time, so I'm going to put a little disclaimer out there that if things get a little wonky, it's because I've never done this in front of a live studio audience before. I've practiced, but things never go right when you are in front of the audience. Okay. There we go. Okay, so what we have here is the regulations.gov website. So once you get to this website, what you can do is just type in Community Reinvestment Act. It will search. And then you can also search it for what's open. But you can see down here, we have Community Reinvestment Act regulations. And it says comment now. So you would just click on that. And when you get here, what you want to do is, this is a spot where you can upload a pre-written letter. It does have a character cap of 5,000 characters, but if for some reason you cannot keep it within those 5,000 character count, you can also upload files that would be the complete letter or any addendums that you wanted to add. There's also some helpful tips on this website. Here is sort of a commenter's checklist. Gives you an overview and helpful tips on submitting a quality letter. And then again, I found it to be very useful. But also, I think one of the things here at the end, as Emily mentioned, there are many organizations that are coming out with talking points and with templates and letters like that. going through, it is important that while these forms and templates are incredibly useful, you always want to make sure that you put in ample detail that is unique to your perspective, to your neighborhood, to the work that you're doing, to how this is really going to impact you directly. Those of you who are heading up organizations, an individual letter will be counted, but if you do a coalition sign-on letter where there are many organizations that are signing off on it, that will still only be counted as a single letter or a single comment. And then, you know, we do recommend that you know, you leave some contact information behind. And then once you do submit your information, you will be directed to a confirmation page that's going to indicate your comment has been submitted successfully. This will also give you your unique individual comment number. And then your comment will also appear online within a few business days. So it's also recommended that once you've submitted your comment online, that you can also submit your comment by email to the FDIC. As Emily mentioned earlier, it is possible that other agencies are going to issue separate and different final rules. So we want to make sure that comments are received by all interested parties. And so we can send out that email, but you can just email it to comments@fdic.gov. And we can send out, as part of our follow-up materials, just a step-by-step guide on submitting a public comment. So with that, I think we have a couple of folks who have asked questions. The first question we have is from Larry. Emily, are you still with us?
Yes, I'm here.
Okay, our first question from Larry is, can you clarify implications if Fed issues different rules from the OCC?
Sure. So each bank has a separate regulator, and the Fed oversees about 15% of banks, including, and even less of that than the ones that actually invest in the housing credit. So there will be certain banks that are currently housing credit investors who may have separate rules from the 85+% of banks that are regulated by the OCC and FDIC. So there are no banks that have that would be operating under the two sets of rules, but it would be very confusing to have, you know, most banks regulated under one set of rules and other banks regulated by another, and that may give them a different appetite for investment in the credit.
Great. And then we have another question. Because of mobile banking, how are assessment areas looked at regarding CRA reform?
Good question. So what the OCC and FDIC are proposing is there would be two kinds of assessment areas going forward. So one would be called facility-based assessment areas, which are the traditional ones that generally align with where banks have a physical presence, so where they have offices, branches, ATMs. And then it would create a new category called deposit-based assessment areas. So any bank that receives half or more of its deposits from outside these facility-based assessment areas would create these new deposit-based assessment areas for any geography comprising more than 5% or more of its depositors. So it could be, say, the remaining geographic area of a state or metro area where outside of where it has a facility-based assessment area. It could be the whole non-metropolitan area of a state. It could be a full state. And again, they'd be able to invest in some of these areas like distressed communities and opportunity zones. So there would be some more flexibility for banks that do a large share of investing in mobile banking, or do a large share of mobile banking, to invest beyond those facility-based investment areas. So it would even out, say, the Salt Lake City phenomenon. But one of the issues that's been raised is whether you know, a lot of the investment would now go towards places like New York and Los Angeles. So it's unclear at this point whether it's really going, it will certainly move things around, but whether it's going to tip the balance in favor of underserved areas is still a question mark.
Great. Do we have any other questions? Okay, so what we're going to do is, again, thank you, Emily, for coming and sharing your expertise. We do plan to send out a recording of today's webinar, a copy of the PowerPoint. We can include links to the public comment, as well as template letters that are being put out by some of the national organizations that are working on this issue. Oh, it looks like we have one more question. Were these changes actively sought by the banking industry or simply part of the Trump administration regulatory agenda?
It's a good question. You know, without editorializing too much, I would say it's a mix of both. And again, a lot of it has to do with Joseph Otting over at the OCC, who is both a former banker and is tasked with pushing the, you know, trying to streamline and reduce regulatory barriers and things like that. So he certainly came in with his own views about you know, CRA examinations and what he thought was fair or unfair about them from a bank's perspective. You know, at least with conversations we've had with groups like the affordable housing lenders, you know, I think there's just a lot of, this early in the process, you know, where it's hard to say what the banks overall see as a, you know, positive versus negative, but I know that there's a lot of pushback around just how are we supposed to figure out what this actually means for banks in the time allotted. So, you know, before even being able to weigh in on, you know, were these the right changes or not, I think that there's just a lot of frustration with the process. So it is something that, you know, they're really wanting to move ahead on with the support of the administration. I will note that there's already been a lot of attention on Capitol Hill, though they're not really planning to do anything on CRA right now. There have been a couple of hearings where you're seeing sort of a partisan divide of, you know, most Republican members supporting the changes, Democratic members opposing them, and it's been kind of shaking out that way. So I hope that lends some insight into where this is coming from, though I will say, especially related to affordable housing, I don't know of any banks that were calling for these changes.
Okay, and you mentioned some folks in Capitol Hill. Is it worth it to maybe submit copies of comments letters to elected officials, whether Senate or congressional members?
I think so. You know, they are not planning any action on, you know, intervening in this process right now, but it's always possible down the road, and either way, you know, depending what happens, we may need to engage legislatively on some ways to offset the impacts of CRA reform on the credit. So having your elected officials looped in the process, especially since your delegation includes members on, you know, Senate Finance and House Ways and Means and Banking and Financial Services, those committees that are more focused on housing and the credit, I think, you know, the more they know about what the impacts could be, the better it is.
Great. So if we do not have any more questions, which it doesn't seem like we do, again, I just want to thank you, Emily, so much for taking time out of your day to go over this with us. And thank everybody who got on today's webinar to learn more about this issue. If anybody has any further questions, comments, the Housing Alliance staff is always available. Emily and her team are available, and we are here to support any members in drafting up their response. And with that, thank you, and everyone enjoy the rest of your day.